Welcome to Nasdaq Trade Talks. I'm your host, Joe Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Chris Dearborn. He's the managing director on Nasdaq's market intelligence desk, and we're here with instant reaction to the Fed. Chris, it's great to have you with me as always. Finally, it's here. We finally got the rate decision, probably one of the most important ones that we've had in a number of years, and the Fed has decided to leave things unchanged. If we take a look at the daily chart, we printed this out around 208, 209. We saw the instant reaction with the markets coming in just off their highs now.
So what you're looking at here is the daily chart of the S&P 500. It's directly in relation to exactly that. The Fed statement that was released. There's going to be more details coming out at the 2:30 press conference, and there'll be a little bit of Q&A. We'll see how that happens. Again, sometimes when you have the Fed statement, it doesn't always correlate to what comes out into the press conference. So initial reaction is that traders have been quiet on the day. We're kind of holding on to the gains that we had yesterday. Yesterday was absolutely a risk-on environment. You had the ECB came out and said that they are going to do what they need to do. They think inflation needs some help, and they got a very dovish statement from Draghi. Follow that up with Trump on a tweet talking about positive trade conversation he had with his Chinese counterpart, and absolutely having a meeting at the G20 gives that oomph that the market has been looking for, and this is the trifecta right now.
Yeah, and you're right. 2:30 really is going to be key here because this adds a little bit of uncertainty back into the market. If you look at the language within the statement
exactly
as well,
what he said, yeah.
Uncertainties to the outlook have increased.
Correct.
No change to outlook growth economy, and expects low unemployment, and that the only cut might be because of inflation. But when you hear a term like that, there's an increase in uncertainty. I'm surprised the markets are kind of reacting the way they are right now.
It's a good as bad. So this statement here is good for both bonds, and it's good for both equities.
And gold.
And gold. And what you're looking at here is really a reaction to the news. Instead of the Fed has become so market dependent that they are really changed their tune from years past where they were data dependent. The data hasn't changed. It's still a growing economy, though slowing from the robust economy we saw last year. Globally, yes, it is slowing, but the U.S. is still doing okay. You have low unemployment. You have consumers very strong spending. Actually got some very surprising strong retail numbers last week. You got confidence in the consumer. And what you're looking at is we're trading less than a half a point from all-time highs. And the S&P and the other broader indexes are doing very, very well. So you're being led by strong names that are benefiting from everything that is going on. And GDP in the U.S. is 2/3 consumer spend. So what you're looking at there is people who are working, people are making money, wages are upticking, but not as much as everybody wants. We don't get everything, but they're still upticking.
Right.
And with that, you have a good sentiment here. The markets themselves will tell you what they think they want. The Fed is going to tell you what they think they want, and the president's going to tell you what he thinks he wants.
And this is what's so interesting, what's coming out of the administration, because Trump has been quite vocal in terms of his displeasure with Powell. But look at this, though. Growth still looks good. Economy still looks good.
Correct.
Unemployment remains low. The only reason that they may cut is because of inflation. That's what Trump is asking for. So it doesn't impact the way they look at the markets. It's more.
It gives him what he wants. It's difficult to get a read on a demand from a moment-to-moment type of item. What the economics are telling us, the economy is good. There's nobody out in the street begging like they were. It's not 2007 and 8 when unemployment was in double digits. What you're looking at here is a strong economy, people putting money to work. And if you're outside the U.S., where are you going to put your money to work? You're going to put to work in the U.S., right? The U.S. stock market has legs to go higher, depending on what happens. This trade agreement gets settled somewhere in the near future. You have positive headlines coming through and then get settled. This market is going to be all cylinders because then the companies can actually forecast what they're going to be spending and what they're going to be earning, as opposed to uncertainties of what's going on between China and the U.S. You take uncertainties out. Investors do not like uncertainties. You take the uncertainties out, you put your best foot forward, and you go with business. This market could go higher. You keep trading with uncertainties. You keep trading on fear. People are scared. Trading volumes are going to tell you that. Monday, the markets was the second lightest trading volume day of the year before the Friday of Memorial Day. You did 5.7 billion shares on that tape. The average is 7.2. Yesterday was a risk-on environment. We did 7.2 billion shares, almost. Today, we weren't even close to trending to that. We're 25% lighter coming into this. We'll see what the last 90 minutes brings. If you keep this up, people are still going to be on the sidelines, and that's why people are still buying bonds. That's why you see the yield in the 10-year trading below 2.10%. You hit a 22-year low the other day, 2.02%. People want to invest. They're not sure where to put it. Clear the deck. Let the economy run on itself. the markets will move higher.
You know, I'm going to take the other side of the trade on this for a little bit here. Even if we do come to an agreement, and we thought we were pretty close with NAFTA 2.0, and the plug was pulled on that.
Yes.
Okay, right? And I think that the global trade uncertainty is going to continue, whether we get positive news or tweets out of the G20, whether we think we've come to an agreement with the Chinese. I don't know. I'm not quite sure how much I would trust a lot of these agreements here. So I think this global trade uncertainty does continue.
It's definitely a fluid moment. It's going to continue to be fluid. There's no certainties in politics, right? You're only a few months away from where it starts to get really heated for the next presidential election. You know, there's going to be a lot of mudslinging. This is definitely going to be, the market and this economy are definitely be weapons that are going to be talked about and thrown back and forth between the two major parties.
And you know that they want to keep this market up at least through 2020. Great for 401ks, a little bit tricky for corporate management setting up guidance, but let's take a look at one of the sectors that has been in the leadership position this year, clearly tech.
Absolutely. Tech is a risk-on trade. You can look at this, the one-year chart. We're looking at dailies here. And what you're looking at from left to right is where it's been. You have the obvious, a big dip in December when we made the 52-week lows and the rally since. What you're looking at the far right, closer to Jill, especially with the green arrow right before the red is today, the greens yesterday, is that risk-on environment. You're trending above all the moving averages here. And you're being led by companies that are heavyweights, not only for the tech sector, but also most of the major indexes. You're talking about Microsoft making another 52-week high yesterday and today. Apple, which is still trading, doing much better than where it was, and a number of the other tech names that are going to move this market higher. It's a heavily weighted sector for the S&P. It's a heavily weighted sector for all the major indexes. Dow Jones, the Nasdaq 100, the Nasdaq Composite. If this sector continues to trend higher and trade above the moving averages, it will be a leader moving forward.
All right, Chris, thank you, as always, for joining me. We'll see you again on Friday. It'll be interesting to get the reaction in the next couple of days.
Don't forget Quad Witch.
Yes, good. A lot of, actually, before we wrap up here, a lot of big volume events coming up. We have Quad Witch, we have the Russell Rebel. We'll be doing a lot of content around that as well. There's a lot going on. We have the quarter end, mid-year, lots going on. This
volumes. Look for this Friday and the next Friday for the Russell 2000 to be two of the highest volume days of the year, topping over 10 to 12 billion shares a day, mostly at the close.
All right, interesting. We'll see that Nasdaq closing across all those shares happening at one time. Wrapping up 2.0, thank you for joining me as always. And thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.